Thanks, Damon. Our next speaker is John Fullerton, who's the founder and president of the Capital Institute. In the previous incarnation, John worked for 18 years at JPMorgan, where he saw the speculative markets at work firsthand. He ran various parts of their capital markets and derivatives business, and he was JPMorgan representative to the committee that was involved in cleaning up the long-term capital management fiasco.
Damon, I could tell you, attest the conference in Cambridge I was privileged to be at myself, and the speech that Ed Turner gave is a must-see for anyone interested in financial statesmanship and regulatory leadership. I'm sure it's available at INET's website, Institute for New Economic Thinking. It's a bit long, but it's incredibly energetic and direct and honest and brave. So I'd encourage everyone to see that. I'm here to express my own support for a financial transaction tax. I will explain my reasoning for this, as well as address what I see as the principal legitimate concern about the tax from the perspective of a financial practitioner. I'm not an economist, and I'm certainly not one of the 6 Nobel Prize winners that was there. Let me first state that I don't believe a financial transaction tax is a proper means to seek retaliation against certain bad actors thought to be at the heart of the financial crisis. Such a tax will be far-reaching and affect virtually all participants in the financial system unless explicitly excluded. I see 3 principal reasons to support the tax. Number 1, and by far the most important, is to combat this short-termism that you just heard about. I believe at the heart of the financial crisis and the ills of our economic system is a malady known as short-termism. We have lost the distinction between real investment in the real economy and short-term financial speculation. FTT should, at the margin, shift investment horizons out to longer holding periods by making high trading strategies marginally less profitable. This would be a uniformly positive outcome, in my judgment. The second reason to support FTT is to improve market resiliency. I believe the financial transaction tax should improve financial system resiliency with only minimal costs to efficiency. As system scientists will well understand, there is a trade-off between efficiency and resiliency. What policy officials need to do is to seek the correct balance between efficiency and resiliency. In its search for ever-increasing efficiency, the financial system became too brittle and it broke. Rapid trading strategies are typically low-margin strategies, collecting pennies on large volumes of trades, either via market-making activity or short-term speculation, or both. Since they are low-margin, they are typically employed with leverage to enhance returns. Such leverage, which can be funded or synthetically embedded in products such as swaps and futures, reduces system resiliency at the margin because in a crisis, leveraged capital tends to be the first to be forced out, augmenting the volatility precisely when it matters the most. Leveraged positions are pro-cyclical and therefore hurt system resiliency. Financial transaction tax alone will certainly not control market leverage, but all else equal, FTT should reduce overall leverage in the system and therefore improve the resiliency of the system. The third reason to support this tax is we need the money. Given the massive growth of financial transactions as markets have become more short-term and speculative in nature, there is an obvious and attractive source for much-needed revenue generation that does not negatively impact the real economy. Given the digital nature of trading, collection mechanisms, ideally instituted uniformly across all major financial centers and products, should be relatively straightforward. I would now like to address the principal argument against a financial transaction tax that I've read in the press and in the papers, which is namely the liquidity argument. Clear thinking on this issue is lacking in the public debate from what I've seen, and I apologize in advance that this does get a little technical, but I think it's worth bearing with me. First, I will generalize to say that markets tend to operate in one of 2 states, what I will call normal states and in crisis states. The impact of FTT in each state of the market is quite different, and the importance of liquidity and resiliency is far higher in crisis markets than in normal markets. In normal markets, which is most of the time, it is true that a transaction tax will have the effect of widening the bid-offer spread to take account of the tax. At the margin, this reduces market efficiency, and in the process, we can expect normal state liquidity to be reduced somewhat. Recall I stated earlier that anything that improves market resiliency will tend to reduce market efficiency. So we must accept a marginal loss in market efficiency if we want to improve resiliency. Note that this is different than efficiency in the economy as a whole. As I stated earlier, I strongly believe economic efficiency would be improved if investment decisions were less speculative in nature and more long-term oriented. Furthermore, I would argue that the value of liquidity in normal markets is vastly overblown. Yes, the largest speculative trading firms care a lot about liquidity. And if asked, is more liquidity better? Certainly the answer is yes. But that's not the right question. The right question is, would you be willing to sacrifice some normal market liquidity at the margin in order to significantly improve market resiliency? This is the question our public officials should be asking. And to this question, my answer is also a resounding yes. Finally, turning to markets in a crisis state, this is where resiliency really counts, and a transaction tax will be irrelevant to efficiency. Let me assure you, when Warren Buffett decided to step in and buy Goldman Sachs stock in the face of the crisis, this was in no way impacted by the fact that he didn't need to pay a transaction tax. Liquidity in a crisis takes on a whole new meaning and relative to day-to-day liquidity in normal markets. Liquidity deserts markets in a crisis for many reasons, but one of them must be related to the amount of perceived leverage in the system, leading to weak hands. This is why reducing excess leverage in the system is important to building resilience. By curbing at the margin high transaction and therefore by definition low margin and high leverage trading strategies, FTT helps build system resiliency. So in summary, FTT is not a cure-all for the financial crisis, but at the margin it will shift capital allocation away from short-term speculative activities toward longer-term investment while improving system resilience and raising much-needed revenues in the process. Thanks.